Good evening to everybody attending this presentation of ours. It's the first time we've done it in this format with the British Club. I saw from the attendance list there are a few people that have been to the presentations we were doing upstairs in the club on a quarterly basis. We will be back. We don't know when that will be, of course. The difficulties being not so much that we know the club is open, and that's wonderful that it is back open, and I gather the run into sort of almost full speed. It's more the restrictions of getting there and getting back into Singapore. So we're watching this space intensely and can't wait to be back. As ever, ongoing thanks to the British Club for our connection to them and the agreement we have with them. The first one of these events started in October 2018. The last one was in February, the last time I was there, the last event that we did. And as I say, keen to get back as quick as we can, but we have to watch that space, of course. So a few things to mention before we sort of move on. We will hope to finish this within an hour at 7:30. That's the plan. What we're doing, and we've found that these things run a little bit smoother if we turn off the attendees' mics and cameras. We found over a period that it works better. It's a smoother presentation, a smoother event. There will be time at the end for Q&A, and I'd encourage you to type your questions into the Q&A box that hopefully you can see. And at the end of this, within about 45 minutes, we'll pick some questions. I don't think we'll be able to go through all of them, but we'll do as many as we can. So at the end, I'll be selecting some questions, and the questions can be to any of the three of us speakers, and I'll introduce the guys in a moment as well. So yeah, if you can write your questions down, that's the best way we'll do this, and I hope to see you at some point in Bangkok in the near future. I'll just say in advance, apologies if the technology does let us down. I'm sure it won't, but you can never be sure. So let's sort of see how we go. But anyway, I know from the attendee list that probably a number of you know me already. Some of you may have met Max as well, but I've been with the Fry Group for 13 years now, based out of the Singapore office. I've been in this industry for sort of 31 years now. It's a pleasure to sort of remain with the Fry Group for this long. It's a pleasure to meet the guys in Thailand and for the British Club as well. So yeah, I've been traveling and visiting Bangkok for many years, and a number of you know me, but a long-standing industry. And I've got the pleasure of having two particular sort of special speakers with me. Peter, who is actually in the Singapore office with me as well. He's the head of our tax advisory part of the Fry Group, which is the tax advisory company, the Fry Group being three parts, which I'll show you in a moment. And also Max has been to Bangkok with me. He's been at the British Club once or twice with me, possibly 3 times, and we'll be back on a regular basis as well in the future when we can travel. So Max is from Schroders. That's the Schroders Asia part. So Max is also based in Singapore. So some or many of you may know the sort of background to the Fry Group and the history and the heritage. As you can see from the logo, the company was put together in 1898, so it's 122 years old now. The origins of the company being tax advice, primarily tax returns to people in the UK, but also around the globe. That was the origins to the company. And such a long-standing history, it's developed over the years. We've now got global coverage. We've got offices in 3 or 4 offices in the UK. We've got Belgium, Singapore, Hong Kong, and most recently Dubai. So we cover most of the globe from these offices. And one thing to sort of say, really, many of the clients have known us over the years for being a tax advisory company. And whilst that's a huge part of what we do, we can't provide local taxation services, but we would always have an introduction to a company that can, no matter where that is. So we can provide UK tax advice, and that's one of Peter's sort of specialities, of course. So otherwise, for anything international, we will always have an outlet. So what do we do? For those that don't know what we do, there are 3 parts to the company, 3 companies within the group, if you like. One of those is called our executor and trustee company. And you can see from the diagram here what we actually do, which is typically sort of wills and trusts, estate planning, LPAs in the UK. We also have the part which I work for, which is our financial planning company. And you can see from the list what we do. And for those who know me in Thailand, we provide investment advice, retirement advice, anything you'd expect from a good quality independent financial advisor. And the last, which Peter actually heads up the advisory part of, is our tax practice. The long-serving guys such as Peter, it's domicile reviews, one of the sort of specialities, very detailed tax advice is required. We also do tax returns, and also something that we are going to look at tonight, which is returning to the UK as a service. So you would have seen the ad, hence why you're attending this webinar, about what we're going to talk about today. So I'm going to cover in a moment UK pension income, some of the things to think about, and the effects of UK pension income going into Thailand, some of the options that there are. Some you may know, some you won't. And then I'm going to hand over to Peter, who's going to deal with returning to the UK, something we're seeing a little bit more these days with the effects of COVID-19. There's been some people losing their jobs. So it's been a case of we're probably seeing more people going back to the UK now. So we have a specialist service for this. And then Peter will hand over to Max, who will be covering the investment markets around the world, and also some additional parts to some of the slides of what's going on right now. It's a changeable feast, and Max is going to cover this towards the end. So without further ado, UK pension income, starting with state pension. Now, many of you will be receiving state pension or due to receive state pension at some point, which is purely based around your national insurance contribution history. If you were receiving the full state pension at the moment, these are the current levels, £9,110 per annum, slightly less for pre-April 2016 retirees, as you can see. Now, what's important to sort of state about the UK pension, as you probably will know if you're receiving this, it's the first part of your income that gets put against the current personal allowance, still available for non-residents. Anything thereafter is taxed at the allowances, the rates in the UK. Anything above the current personal allowance, which we still get as non-UK residents at the moment, 12,500, is subject to tax at the prevailing rates. Now, as you will know, if you're receiving state pension can be paid to you pretty much anywhere around the world. But what you'll know as well, if you're in Thailand and you're receiving the state pension, you don't get the state pension increases each year. They only apply, as you can see from the slide, to people in the European Economic Area, certain other countries, or any countries where there is a specific social security agreement with the UK. And as you may or may not know, I've mentioned it once or twice in one of the events we did a year or so ago, that in the area, it's only the Philippines that receives those state pension increases because of that social security agreement with the UK. So in Thailand, it's frozen, as you know. Whether that remains the case in the future, there's been many petitions over the years to try and change this. It hasn't been changed so far, but again, we can just watch this space. Now, you may have heard this terminology, triple lock guarantee in the UK. Now, what this means is there is the highest of 3 different increases each year. Whether you've read the news or not, there has been an increase statement for next year. Thereafter, there's no guarantees this triple lock will still be available. It's under discussion at the moment. It's expensive. I mean, it was an expensive addition when it was introduced, and the point of the deliberation at the moment with the government is the cost involved in doing this in the future. So we'll have to see what happens as we go forward. Something I mentioned at a presentation we did in the club a year or so ago, that if one goes back to the UK for a slightly longer period than a few weeks, it's possible to apply to have your state pension increase for that period. Now, some may say, is it worth it? It depends on how long you're there, but if you're there for a few months, it's surprisingly worthwhile. Okay, but you have to do this yourself, and you'll be able to see from the bottom, you'd have to get in touch with the pension centre, either by telephone, or you can write to them. Being part of the government agencies, it may not necessarily be the easiest thing you can do. However, a British Club member did this. It was in the audience, I believe, when I was talking about this before. He achieved this, and it was surprisingly worthwhile doing. So this is a big slide. There's lots of information here, and literally what I've done is I've just taken a snapshot from the double taxation agreement between the UK and Thailand. And I'm only really referring to the bottom of this slide. You can see Thailand mentioned here. And there's a couple of columns there. There's a column that says government pensions at the top. And at the bottom, you'll see it says full relief against Thailand. There's also a personal allowances. It says yes. And then interestingly, if you look at the bullet point on the right-hand side, number 4, you'll see that the treaty does not include an article, etc., for anything other than government pensions. So non-governmental pensions, there's no article. Okay, it's interesting. No more on that slide, but if we look over, what you'll see here is when we're talking about governmental pensions, we are literally talking about civil service, NHS, local government superannuation, teachers' pensions, those kind of things. So there's another clause at the bottom, and again, this is taken directly from HMRC, and it refers to how the double taxation agreement actually works and the sources of UK being from the UK itself, the sources of income, and that the credit against Thai taxation is possible. But if you look back up on that slide on the right hand side, you'll see that point number 1, and it says relief may be restricted if all the income is not remitted to Thailand. So basically, and people that live there and have lived in Thailand for a long period of time, you'll know that most people don't remit income into Thailand in the same year it's received. It's normally the year after, and in particular the Thai tax year is calendar year, so it's normally the year after for specific reasons. So if one has a situation of needing to reduce the tax in Thailand and not pay 2 lots of tax, perhaps with the UK as well, it does mean that remitting all of the income from overseas into Thailand is a requirement. That's why I mentioned this. So more about the double taxation agreement, and you'll see the first 2 bullet points there start talking about this contracting state and political subdivision. And then bullet point B says the pension would only be taxable in the other contracting state. The bullet point at the bottom is the most important thing on this slide and the previous 2 slides. The only way you'd get a double taxation agreement in place in Thailand is if you have a civil service pension, a government pension, not the state pension, and you have become a Thai citizen. Those are the 2 important factors. Okay, and so far, and I've said this before to a few people, so far I haven't met anyone who meets both those criteria in Thailand in my time, which is 10 to 13 years now. So it's very difficult to get in place a double taxation agreement between the UK and Thailand. Not impossible, but it's quite difficult. So that's one of the methods of reducing taxation on UK pension income going into Thailand. So it's the double taxation capabilities, but as you can see, it's quite restrictive, quite difficult. This is another way, which is not as well known as the double taxation agreements. Now, this relates to occupational pension income, as you would have called it perhaps in the past, defined benefit pension income, final salary pension income, the old-fashioned pensions, which have guarantees attached to them, and once in place, they are guaranteed and normally inflation-proofed. So if one has a decent service in a scheme of that order, and that pension is in payment, there is some criteria that if the criteria is met, it's possible to have the pension income removed from PAYE in the UK, meaning that it's paid gross from the UK to be taxed locally. Okay, so we've taxed locally, gross from the UK. The criteria being, as you can see, there's a few bullet points below, but in a nutshell, the last 10 years of when you were a member of that pension, you were overseas. Okay, the service carried out overseas was more than half of the total service of that pension scheme, the membership, and it covered at least 10 of the last 20 years. So if the criteria is met, it's an application to HMRC. It's not an application to the Thailand Revenue and HMRC, which is more difficult to achieve. It's an application based on meeting the criteria along with some other information directly to HMRC. Okay, but that's only for defined benefit income. That's the final salary income. Okay, I'm sure you may have seen this terminology mentioned over the years, particularly it was launched in 2006, changed heavily in 2017. I've met many people who have these plans in place that have had advice from previous advisors. We've advised upon this. We've put in place some of these pension schemes when they're appropriate. And what changed in 2017 has perhaps made it a little bit awkward going forward to ever use this again. But in the meantime, what used to be very popular, and I'm going back to really sort of 2007, really just after they were introduced, Guernsey was a wonderful option because it was possible to move a UK pension to a Guernsey pension, and the income from that was paid with no tax at source. When that changed, and HMRC have been messing with this over the years for many occasions, Gibraltar was probably the most sensible for use in Thailand because there was only 2.5% tax at source taken on income. So things have changed over the years and they have varied. It's been one of the things that HMRC have been closely attached to because I don't think they realise the flow of money out of the UK pensions into these offshore pensions. I've seen many occasions that Malta has been used for those in Thailand, which was a concern because Malta is not based on an amount of tax at source. satisfying HMRC's requirements. It's based on double taxation agreements. It's one of those style of QROPS pensions. So where Malta is used for those living in Thailand, there is no double taxation agreement that exists, even up to today, because I checked, which means that ordinarily pension income would suffer 35% tax at source in Malta, which may be higher than would have been the case if it was in the UK still. So we don't know, but we can provide advice and assistance to people where we've seen this in the past. But it's a concern sometimes because it could end up paying more tax, which was one of the concepts of QROPS, to pay less tax. Last from me on QROPS, there was a big change in March 2017. And after this point, the government said, well, unless you are an individual and the pension that you're going into from a UK pension is going to be in the same country, or both of those things, that's you and the individual, are in the European Economic Area, or it's a company scheme, which is also a QROPS. Unless one of those things applies, if you move money into a QROPS now overseas in any location, there's going to be a 25% tax charge, which means that realistically, it's not going to be the right thing to do on probably every occasion, particularly for those who live in Thailand and around the region, that using this is going to be effective. The scope of that also was widened to those that moved into QROPS for 5 years thereafter. So you have to be very careful with these things. They are a wonderful tool when they're appropriate, but otherwise it's not always the case. And we've seen things where they're not appropriate. So I'm going to hand you over to Peter now, who's going to talk to you about going back to the UK and many of the considerations.
Okay, thank you, Martin. So UK repatriation. So when you plan your return to the UK after a time living overseas, there are a lot of ducks you need to get into a very neat little row. And the first thing we're going to think about is the date you're actually going to become UK tax resident. So why do you care about that? What's the big deal about being UK tax resident? So your UK tax resident status determines how much tax you pay in the UK. If you're not resident and you've been non-resident for more than 5 years, generally you're only charged to UK tax on UK sources of income, subject to relief perhaps under a double taxation agreement. You're also charged to UK capital gains tax on the disposal of UK land and property. But pretty much everything else is outside of the scope of UK income tax and capital gains tax. But from the date you actually become UK tax resident, if the UK is also your home country, so you're what we call a UK domicile, which I'll explain that in a little bit. If you're UK resident, you're UK domiciled, you're fully liable to tax on your worldwide income and worldwide gains as they arise. So your UK resident status is incredibly important, and your precious non-UK tax resident status, which reduces your exposure to UK tax, should be preserved as long as you possibly can. Now, I mentioned 5 years. So what happens if you're outside of the UK for less than 5 years? So if you've been resident in the UK for 4 out of the previous 7 years before you leave, you're outside of the UK for less than 5 years, and you come back again, we have some particular, what we call anti-avoidance rules that kick in at that point. So when you return to the UK after a period of what we call temporary non-residence, you may be charged to tax on certain income and gains which you've received or you've remitted to the UK in that period of temporary non-residence. So if that's you, take some specialist advice because the rules are particularly complicated. But I think that the big application for this is around capital gains. So you owned an asset while you're in the UK. You went overseas. You're overseas for less than 5 years, and during your time overseas, you sold that asset. You're charged to capital gains tax on the sale in the year that you return to the UK. So these rules only kick in if you've been outside of the UK for less than 5 years. Okay, so understanding the date you're going to become UK tax resident. Very important, because that's the date you're going to come fully within the UK tax net. We have a complicated statutory residence test for UK. And under that test, you're either resident for the year or you're not resident for the year. And the default position is that if you're resident for the year, you're resident from the 6th of April, the beginning of the tax year. But what about if you come to the UK partway through a tax year, say in October or November? Does that mean you're going to be taxed on everything you've earned overseas right from the 6th of April? No, there's something that helps you. We call this split year treatment. Split year treatment prevents you from becoming UK resident from the default date of the 6th of April. And it preserves that really helpful non-UK tax resident status for longer in the tax year. And it keeps, for example, your overseas earnings out of the UK tax net for a bit longer. Split year treatment is very complicated. There are 5 different ways you can become UK tax resident partway through a year. So it's one of those times where you certainly need to be speaking to a professional who really has a good understanding of the statutory residence test and split year treatment. Okay. So we've briefly covered a little bit on a tax resident status, but for UK tax purposes, everybody has another tax status, and we call this your domicile status. Your resident status is assessed each year, but your domicile status is pretty much assessed over your lifetime. Generally, and it's a very general comment, you ordinarily acquire a domicile of origin from your father when you're born, and it pretty much sticks with you. But matters can be far more complicated than that. Now, if you're a UK domicile, when we think about inheritance tax, your worldwide assets, everywhere, everything you have in the world, is within the scope of UK inheritance tax. That inheritance tax charge could be 40% on everything you have above £325,000. A very significant tax liability that could be hanging over you. But if you're not UK domiciled, so perhaps you were born of parents who themselves were born outside of the UK, you were born outside of the UK, maybe you've never lived in the UK, but this is the first time you're coming to spend some time in the UK. It could be the case that you are not UK domiciled. A non-UK domicile has a very different exposure to that hefty inheritance tax charge. So a UK domicile, worldwide assets are within the scope of inheritance tax. Non-UK domicile, it's only UK assets that are caught for UK inheritance tax. So that non-UK domicile status could be very, very advantageous to you. And that non-UK domicile status not only determines an exposure to inheritance tax, but also a non-UK domicile can exclude unremitted overseas income and gains from UK tax when they're resident in the UK, provided that various and complicated conditions are met. So perhaps you're not UK domiciled and you're resident in the UK. There are a couple of things to say to you about that. The first is that you are able to benefit from a special basis of taxation. Now, somebody who is UK domiciled and resident in the UK is taxed on their worldwide income and gains as they arise. But somebody who is not UK domiciled, yes, they'll be taxed on their UK income and gains, but their overseas income and gains can be excluded from UK tax. As I say, that's complicated, And there's lots of good advice to give you about that. I mentioned the inheritance tax advantage of being not UK domiciled, but the thing to note about being not domiciled but resident in the UK is that you've started a clock ticking. Your really helpful non-UK domicile status has a shelf life. It's not going to endure. The longest you're going to be able to enjoy that non-UK tax domicile status is 15 years of UK residence. But if it's clear you've chosen the UK as your home country, your permanent home, your non-domicile status could evaporate far more quickly. Brief mention of some of the sources of income that you want to think about when you think about your return to the UK. Just a few mentions on this slide. Termination payments, particularly tricky, very nasty rules around termination payments. And it could be the case that a termination payment, which has nothing to do with the UK employment, will be fully charged to UK tax if you are UK resident at any point in the tax year in which you become entitled to that payment. There are ways around that, so please do speak to us about that. Share schemes, long-term incentive plans, very tricky for UK tax purposes. There are income tax and capital gains tax consequences for these kinds of share schemes. If the date you were awarded the shares, from that date to the date the shares are released to you, so award to release, if there's a UK residence period in that time, then there are UK tax consequences. Very brief mention on bonuses. So if you have a bonus and it relates solely to your time when you are not UK resident and work doing UK work days, then it's not going to be subject to UK tax, even if it's paid to you after your return to the UK. So that's a special rule for cash bonuses. Briefly on your investments, there's lots and lots we can say to you about this. So very general advice. You're coming back to the UK. You've understood the split year date. You know the date you're going to become a UK tax resident. So before that date, sell assets standing at a gain, and you're going to avoid a future charge to capital gains tax in the UK. Assets standing at a loss, bring those into the UK, sell as a UK resident, and then you can enjoy that loss to set off against future capital gains. Final point on this slide is overseas pension schemes. Very complicated indeed. The one thing that I would say to you is don't not think about your overseas pension scheme. Don't put it to one side in the too difficult box. Do actually speak to somebody just in case there's an action you can take with your overseas pension scheme now while you're not UK resident, which is going to save you an awful lot of tax in the future. Special rules for UK land and property. We talk about UK land and property extensively with our clients. So as a non-UK tax resident, been outside of the UK for more than 5 years, sell a UK residential property while you remain UK non-resident. It's only the gain arising after 5th of April 2015 that is charged to tax. If you've owned the property for many, many years, that could be a very big advantage. You have 30 days to report a sale and pay any tax due to HM Revenue and Customs. Really tight reporting deadline on that one. And if you're selling a property which you've lived in as your home at any time, just hold on a second, take some advice. There could well be a way to maximize some what we call main residence relief, which is going to save you capital gains tax. So thinking about life in the UK, one of the pieces of advice that Martin and myself help clients with is just to think about a tax efficient strategy for life in the UK as a UK tax resident. It's a very confiscatory tax regime, but there are efficiencies there if you can find them. Very briefly mention lots of allowances here that are available to you each year on a use it or lose it basis. Do take advantage of them. We can help you with this. Okay, so consider inheritance tax. It's better to consider inheritance tax while you remain UK non-resident. A couple of reasons. Firstly, if you're not UK domiciled, then the time to take action on that for inheritance tax purposes is while that non-UK domicile status is beyond question, while you remain UK non-resident. Secondly, one of the simple ways to save inheritance tax is to reduce the value of your estate by gifting assets to the next generation. If you do that as a non-UK tax resident, there is no capital gains tax to pay on that gift. If you do it as a UK tax resident, making a gift of an asset to a child, that's chargeable to UK capital gains tax. Finally, from me, tell HM Revenue that you've returned to the UK. So it's really quite easy. When you actually physically arrive in the UK, the only thing you need to do is make sure HM Revenue have got the right correspondence address for you, because you don't want to miss any of those vital communications they're going to send. Your return to the UK, a claim for split year treatment, for example, a declaration you've become UK tax resident again, that's all taken care of in your annual tax return. And I've just put up the filing dates for that, for the current tax year for you. So at that point, I'm going to hand over to Max.
Thank you very much, Peter. Good evening, everyone. And thank you as well to Martin and to the Wright Group for inviting me to speak on this seminar this evening. So I'm going to talk to you a little bit about the investment market and what we've been seeing. I think I had a brief introduction from Martin about Schroders and what we do. As he said, I'm based in Singapore, and we have a speciality in discretionary fund management for private individuals. So we manage discretionary portfolios for the long term for clients. And so what I want to set out to achieve today is just to take you through a little bit of the investment landscape, what we've seen this year. It's been an eventful year. 2020 will not be one to be forgotten. And the fact is that the events of COVID and the markets and the economic situation are obviously inextricably linked. So what I wanted to do is talk to you about three main topics. Firstly, the state of the markets, what we've seen. Secondly, the implications. Secondly, I wanted to touch briefly on inflation, largely because inflation is such an important factor, as both Martin and Peter will tell you, when looking at your finances, and it's really vital to monitor it. And then thirdly, to look to the future, to think about what themes are going to work in terms of the next 5, 10, 15, 20 years, and how to gain, how you should be positioned to get hold of those returns, and try to also cast some optimism on the environment, because this year has largely been a pretty horrible year. Everyone focusing on the negative, and I think, you know, the idea of investments are that they grow, and so we want to be firmly positioned in that space. So very quickly, four main factors if we look at this slide here on outlook, and obviously the economic situation has been dire. March, April 2020, extremely volatile, and we saw economies going into recession, lockdowns, and we've only recently seen now GDP, gross domestic product, figures being published for the UK and the UK and the US, which have now come back up, and we're starting to see some kind of a recovery. But the extent and the strength of that recovery remains unclear, and we also there are clear risks to come. Second factor is valuation, and I'm sure a lot of you, when you're talking about your portfolios and your investments that you keep an eye on, you'll probably say to me, Max, everything's quite expensive at the moment. Everything's moved up a lot, and you're right. Equities, particularly in the US and in technology, are very expensive. Bonds, particularly in Europe, where the flight to quality, as they call it, people buying government bonds because they're scared of losing their money, has really taken hold. And actually, these bonds are yielding at negative levels, which basically means they're overpriced. But at the same time, we do see in terms of valuations that there are opportunities out there and there are pockets. So, for example, the areas that have been really beaten up, so the banks, the travel and leisure, which obviously still has some way to go, to a point, materials, and obviously energy, which is a big component of the FTSE 100. Then sentiment. We look at sentiment and we define that really as, how do investors feel? And the fact is that sentiment has improved and in some cases has become, I guess, euphoric, particularly around technology. But really what is underpinning it all, in my opinion and in our opinion, are central banks flooding the market with liquidity and ultra low interest rates, because those having lots of money sloshing around the system forgives a lot of problems and ills. And then lastly, risks. So US election, we've just had that, and I think risks do remain because it is doubtful as to how the transition will play out. They're not real long-term risks, but they are going to cause volatility likely. Brexit, hopefully we'll see the back of Brexit soon, over the next couple of weeks perhaps, but that's probably one of the more positive of these points. COVID is obviously remains a big issue, and all of these have impact on global trade. So if we launch into the first of our points around the state of the market, and this chart here is the All Country World Index with dividends reinvested, and you can see how much we've recovered. And actually, this is a little bit old, so it's gone up even more. But essentially, there are lots of positive and negative factors out there which will continue to cause volatility. As we've seen in this chart, it wasn't a straight line up, and it won't continue to be a straight line. But I think that particularly in terms of equities, there is still good support for equities as long as, so if you think about these factors, corporate earnings have been relatively good, in line with expectations. So that's what it's all about, really. It's about whether they're in line with expectations, and expectations have come down quite a bit. Obviously, we're going to see positivity around the vaccine, which is good. But then obviously on the negative, and also we've got the liquidity, but on the negative side, we're going to see outbreaks and reoccurrences of COVID. But at the same time, we did see a very significant surge up in the last couple of days on the back of news around the successful vaccine coming out of Pfizer. So I think we have to be very cognizant that things will move quite fast when they do come. This is the composition of the returns that we've seen in 2020, and there are no big surprises here. We've talked about it already. The US is a standout; it's done very well. Technology has done well. Some of the more defensive, so consumer discretionary, communication services, healthcare have done well on the sector side. And if we look at the laggards at the bottom, we can see the UK, it's an exceptional circumstance really given Brexit. But unfortunately as well, as you can look at the sectors on the right-hand side at the bottom, the FTSE 100 has all the wrong sectors in it. It may have worked well in past years, but this is why it's lagged so much. It's got so much in terms of international energy, oil companies. It's got so much in terms of banks, international banks, which suffer in a low interest rate environment, as well as other factors. And then really, what are we looking for? We're looking for an uptick in activity for things to improve from an economic standpoint. And that is, that's some way away, right? We're still seeing lots of restrictions, which mean that a lot of people can't go out, they can't travel, they can't do anything. The second topic I wanted to talk about was inflation. And inflation in the US is slightly more robust than it is in, more prospect than it is in the UK, and this is reflected in performance of Treasury, of inflation protected and linked securities. But inflation is really important, and I think actually in both scenarios, whether it picks up a lot or if it stays at its low level, there's room for investments and equities to do fairly well. And the reason for that is because as long as inflation is low, then liquidity in terms of central banks and interest rates will be plentiful. That is a relatively constructive environment for good quality global equities. If inflation were to pick up, because of all this unprecedented flooding of liquidity, then equally, while you might see a sort of a short-term readjustment in terms of equities, in an inflationary environment, equities would adjust probably because interest rates would be likely to be heading up. In an inflationary environment, equities are not a bad asset class to have as well, along with property and real assets. What you don't want in an inflationary environment is bonds. So that's why it's important to keep an eye on inflation. This slide I'll just dwell on very briefly because it shows the extent of the downturn here that really plays back to my first slide when we talked about economics. And you can see here this 4.6% down in 2020 in terms of global GDP. This is global GDP we're measuring here, is really significant in comparison to the past. And so lastly, and what I want to spend the next few minutes until I close on is some of the themes really that we seen played out this year, but then we really think are important going forward for inclusion in investment portfolios. And there are other themes, but these are the four main ones that we think are so important. And obviously technology is something, it's not a new story. It's been going on for some time. You look at digital penetration in terms of commerce globally is still, in terms of global commerce, and obviously this includes a lot of countries that are a lot less developed than the ones we live in or come from. It's still in single digits, so it's very, very low. So there's lots of growth to continue, and this is termed digital transformation, and this is something which we believe in heavily. So, for example, cloud computing, software as a service, e-commerce, perhaps less on the business to consumer side and more on the business to business side, helping companies with their supply chains, helping them with their inventory. This kind of thing is really, very exciting. And so there's this, you've probably heard it before, this 2 years of digital transformation in 2 months, essentially March, April, May time. It was by the COVID forced this transformation, and this will continue. And this is just really important to have a good handle on. It won't be a one-way trade, and it will be up and down, but it's important. Healthcare is just a fact of the world we live in, that people are living longer and people and countries are more prosperous. So therefore, you're going to see more healthcare spend. And also healthcare has the benefit of hopefully growing over time, but also being defensive in certain periods of volatility. Thirdly, economic populism and rising government debt. I mean, Trump was not the first populist. He won't be the last, but he's probably one of the most famous. And you saw the showing in the election. This will continue, and we're seeing pressure everywhere for governments to dole out more largesse to their people, to deflect from other issues. And this will have impact. Printing money will have, and irresponsible finances will have huge impact on government debt levels around the world. And then lastly, sustainability, which is kind of really what we are very well positioned for this at Schroders. And it's something we try to weave into everything that we do, trying to invest responsibly and focusing on longer term trends like climate change, and how to be on the right end of those trends, both for altruistic reasons as well as economic reasons. So in my closing statements, I will just focus a little bit on kind of like some of the main areas where we think that there is opportunity, and it does remain in equities there are pockets of value, but even expensive markets will continue to perform as long as you get your fundamentals, so your strong cash flow and your balance sheet strength correct. Really, in terms of bonds, it's credit or corporate credit, corporate bonds that we like. And gold is an important diversifier in portfolios. We really can't forget that, because it is up, at one point it was up 30+% this year, and it gives you ballast in portfolios. That's super important. And I guess the last point really is in an income-starved environment, we look to assets like infrastructure to help us to benefit from a stable income flow, because we can't rely on banks anymore and oil companies, as you know. And then the last slide I'll leave for you when you do get a copy of these slides to read yourselves. So thank you very much, Martin, and I will hand over to you.
Thank you, Max. So there's two things that we'll do now. There are a few things to say, which is thanks to the British Club again. The association with them has been wonderful. It's very nice to be sort of involved again, and we thank you for the time that you have spent as well during the course of your evening. I'm very much looking forward to meeting with you and being back in Thailand again at some point shortly. And in the meantime, I think what we can do at this point, there are some questions that we've received in, so I'd like to sort of run through with those. We still have a sort of 10 minutes or so we can cover a few of these. So there was a question that came in that to say, and I think this is one for you, Peter, which was we have a property in the UK that we're considering transferring the value to our son. And what would be the implications of that? If I can ask you to respond to that one, please.
Yeah, so property in the UK, if you dispose of that, the gain is always chargeable to UK capital gains tax, irrespective of your UK resident status, whether you're not resident or whether you are resident in the UK. Now, a gift to a child is a connected party transaction. And what this means is that when you calculate the gain arising on that disposal, because you are getting rid of something, you use market value at the date of the gift to work out the deemed proceeds of sale. So if you're not UK tax resident, the way you're going to calculate that is perhaps look at the 5th of April 2015 valuation provided to you by somebody who's a member of the Registered Institute of Chartered Surveyors. Compare that with the open market value of the property at the date of gift. The difference is what you're going to pay capital gains tax on. Now, you have to report that disposal within 30 days. You have to pay any tax due within 30 days. If you're making a gift, of course, you're not getting any cash in return. So it's very important to understand how much tax you need to pay within that really tight 30-day reporting deadline to make sure you've got the funds available. Now, if the property's ever been your main or only residence at any time, there can be further reliefs that kick in that can help matters. So that's a very rough overview. We'll be happy to engage with you and take you through the detail of that. But that's the kind of the bones of it. Okay,
another question which came in. We've had a few of these, so as I say, we've got about 10 minutes left. We'll try and get as many of these as we can. There's one which is basically, what's your current view of the UK equity market? Can I ask you to respond to that, please, Max?
Yeah, of course. Yeah, so as I sort of briefly mentioned in my piece, the UK equity market is an odd beast because it has a real focus and a real bias towards international financial institutions, energy companies, largely oil and gas, and other materials companies, so to speak. So the likes of Rio Tinto, for example, companies that are extracting minerals and other materials from the earth. And so that can work really well, and that can work really badly for the UK. When the dollar was really strong, and the pound was weak that period a while ago, a couple of weeks ago, a couple of years ago, 18 months ago. Obviously, dollar earnings were very positive, and that was great, and it helped to helped with the UK market. But at the current environment, where you've got a perfect storm in a really bad way of Brexit uncertainty, and you've got these companies where, in the case of fossil fuel energy companies, where they're going through an existential, particularly in terms of investment and investors, an existential period, threat period, because there is a real danger that investors going forward, particularly institutions, may not allocate to them because they're worried about the future of fossil fuels. Will they get taxed more? There's real risk around that because of the climate change issues. So the market's been beaten up because of that. Now, our view is we are fairly constructive on the UK. We think that obviously it's been oversold. The problem is the timing. You just don't know when it's going to come back. But obviously we saw it's closed. The valuation gap has closed quite a lot over the past couple of weeks. It's performed much better. And so, yes, I think that it makes sense from a sort of as we would say, mean reversion. So that disconnection coming back. So it should do a lot better. Now, if you get some kind of Brexit closure to that issue, then it and sterling will obviously both do well. And my last point, I guess, is really think about the UK market in terms of your overall allocation, because I think in the past people have allocated too much to the UK market because it's the home country, because it's the home bias, it the most, and we're all guilty of it. But the fact is that the world is, UK is a big, decent economy, but the world is growing in these other economies dramatically, and we have to be careful not to have too much in the UK in a portfolio which should be, all our portfolios now should be global. Obviously, the only caveat to that is your currency exposure.
I think even currency over the last few years or so, there's not been much of an adjustment, and you have to think about that for the future. But I think it's fairly safe to say, in looking at the results of your slide earlier, the shift away from a UK bias in a portfolio for a Brit with sterling, you could almost argue is taking a flight to the US. Without a doubt, I think the results are significant.
Yeah, that's right. And I guess the question, I rambled a little bit, but the question, what do we think about the UK market? Yes, it's a good question, because the UK market will likely do well if we get some kind of Brexit conclusion. But we've also got a lockdown now coming in. So there are pros and cons to that trade.
Thank you, Max. There's another question which says, I have an existing QROPS. Should I consider putting more money into this? I guess that's probably most simplest for me to answer. Simple answer is no. The reason being is that the QROPS plans themselves kind of mirror the pension legislation in the UK, which means that if they're from tax relieved pension funds, the origins of those monies in the UK, that gives them inheritance tax treatment. Which is preferable inheritance tax treatment. As soon as you put some individual money in there, you sever that link, amongst many other factors as well, like restriction to access, normally sort of 25% as a lump sum and income, and then the tax issues and other things. So it's a device that we can provide, I can provide, but the simple answer is no. There's another question, which is, during the course of the presentation, you mentioned the point being on the tax side was the UK return and the fact that we offer this as a company. This is to you, Peter, of course, it's on the tax side. How long in advance of going back to the UK should someone engage you, the Fry Group, for that kind of tax return service? What do you think?
I think 12 months is an ideal lead time for us. The reason for that is there could be quite a lot of planning that needs to be undertaken before the date you're going to become UK tax resident. And if we're going to suggest to you that you're going to dispose of perhaps some quite illiquid assets, such as UK property, for example, that can take some time to actually be disposed of. In addition, please tell me, say 12 months before you plan to return to the UK, because the date you actually physically return to the UK may not be the date you actually become UK tax resident and fully within the UK tax net. It could be the case that you actually become UK tax resident a few months before you physically return to the UK. So do give me as much warning as you can. 12 months is ideal, and then we can look at everything for you and make sure that you're going to be as tax efficient as you can for life in the UK.
Super, thanks, Peter. There's two more I think we've got time for, just quickly. One of those is you indicated during the presentation about the shedding the tax at source in certain circumstances on defined benefit pensions. If I already have a pension in payment, could I do something about that? I would have said maybe Peter can answer this, I can answer this, but I've seen this many times before, and simply we've gone retrospectively back for people. That is not too difficult to actually claim that exemption for the overseas service. It's not as difficult as the DTA, depending on the country you're dealing with. But otherwise, what I've seen historically has been it's been enacted from the moment the advice is provided thereafter, and also claiming back tax paid unnecessarily. So it can be nice sometimes that we've seen these cases where some of our tax advisors over the years have provided this service and retrieved back tax and also made it tax-free going forwards in the right circumstances. So yeah, it's great, and we can talk to anyone on that side. One more question, I guess, for Max, I think. What do you think, this is as broad as it's long, but what do you think is probably the biggest risk for the global investment market, let's say the equity market, in the next 6 to 12 months? I mean, forget the election's been and gone much without a whimper. We know Brexit's there, but is there something in particular you think is possibly most damaging coming up?
Inflation and interest rates. That's basically it. That's what drives everything. That's why investors have done such a good job of pumping up asset prices, and that's why you need a proper strategy to be able to navigate that. Because if we see a sign of inflation getting ahead of itself, then although central banks, particularly the US central bank, which is the Federal Reserve, although they have said that they will take a different measure of inflation to try to fudge the numbers a bit and to try to encourage inflation, I do think that if it spikes too much, that they'll probably chicken out. Because don't forget that central bankers always have they're born with a fear of inflation and being, not being able to get the inflation genie back in the bottle.
Okay, wonderful. Thank you, Max. Obviously, sort of, if you wish to get in touch with us, as I say, I'm there regularly. You know, some of you guys know this, some of you guys already have met me, but otherwise, this is the way to get in touch with us, which is the advice at thefrygroup.sg or www.thefrygroup.co.uk. Follow us on LinkedIn as well if you can, because then you can get to see the regular updates and all the news that comes through. Some very interesting stuff there. Thank you very much. There's a couple of things I will say as well. Part of what we do with the club and part of the agreement we put in place with them a couple of years ago is also about, you may have seen some articles in the Outpost magazine. It's something that I do every month. We do 2 pages in there. It's normally in the first 10 pages of the magazine. So Outpost is on the British Club website. It's updated very quickly. The hard copies come out into the club and also distributed elsewhere. You'll see us on some of the notice boards and the poster boards around the club for these events that when we do them. As I've mentioned earlier, I can't wait to be back. I'm sure we can't wait to be back, because I know that probably Max will come over with me at some point, and maybe Peter as well. That would be quite nice. So we shall see. But looking forward to seeing you personally. And again, thank you very much for the time that you've spent with us this evening. We hope you found it useful. We try to be as informative as we can and provide you with a few different subjects to keep it as interesting as possible. But again, thank you very much for your time, and we hope to see you soon. Thank you.